Hello, everyone. Welcome to today's webinar. My name is Gwen Roush, and I'm joined by my colleagues Dave Putro, Joe Shmigelsky, Sgorlon, Wasiq Chughtai, and Hatim Jivanjee. We are with the CMBS surveillance team with DBRS Morningstar, and we wanted to chat with you guys today about some of the things we've been monitoring in the last year, specifically with regard to regional mall loans and the impact of some of the developments with regard to rating actions in 2021. We have a pretty full schedule. I probably take the full hour, but I'm hopeful we'll have time at the end for questions. So if anybody on the line would like to put something in the chat, we'll try to get to those at the end. And if not, we can circle back after the webinar. So like I said, wanted to talk about trends with malls, walk through the slide deck and some of the things that we've noticed. I think obviously, talking about malls and impact to CMBS transactions isn't a new topic. We've covered this even prior to the pandemic. Obviously, there have been issues with the changing retail landscape that have caused issues. And I think what we saw, with the onset of the COVID-19 pandemic, you had obviously a significant increase in special servicing rates and delinquency rates right at the start of the pandemic. And those trends continued through most of 2021 and into early 2020, through 2020 and into 2021. And, for us in the last year where we've taken ratings downgrades, not all of those have been tied directly to mall loans, but a good number of them have. So obviously top of mind for us. And I think, in looking at the rating actions that we took in 2021, we have about 230 multi-borrower transactions that are rated by DBRS Morningstar. And across that book, we took rating actions at the bond level just under 3,500 times. And of those rating actions, about 159 bonds were downgraded. Of those, 56 were investment grade prior to the downgrade. And, that's a relatively small number, but I think it's worth pointing out that we also have about 455 bonds that retain negative trends. And of those, about 161 are investment grade. So, it's been an interesting year for us as we've seen some of this stuff play out. And, like I said, we have negative trends. We're obviously continuing to monitor things. So, in that vein, I wanted to turn it over to Dave Putro to kind of expand on the drivers for those rating actions and the things that we'll be monitoring for those bonds that have negative trends.
Thanks, Gwen. Morning, everyone. So we were obviously much more active in 2021 than normal, especially on the downgrade side. But as Gwen noted, comp firms were still the bulk of our actions last year. But look at the downgrades for a moment. The majority of the downgrades were fueled by regional mall exposure, although hospitality properties were also contributors, as well as some one-off distressed properties across other sectors. And I think when we look at regional malls in particular, as appraisals started coming in once the pandemic had really manifested itself, it was sort of unclear to us, and I think to a lot of market participants, especially from calls that we received, as to how much, sort of being in the depths of COVID with lockdowns and restrictions, how much was that influencing the values. But I think as time moved on, we began to see a fairly consistent view from appraisers in terms of cap rate ranges on these distressed properties, which ultimately resulted in a fairly consistent range of value declines from issuance values. And this ultimately helped shape our credit views on deals, as we're able to build additional stress into our analysis, even before new appraisals were reported on newly defaulted properties, by taking some of that information that was coming in on appraisals, looking at cap rates, looking at haircuts to issuance values, and making some assumptions on how particular loans were going to, or particular properties were going to work themselves out. And as I mentioned, these value resets on regional malls, just focusing on that for a moment, these value resets were one of the biggest contributors to our downgrades last year. But as Gwen mentioned, there remain 450 bonds on negative trends. So I want to take a moment to look into 2022 and run through some things that we're still concerned with, which will ultimately likely determine whether those negative trends end up resulting in additional downgrades. So first and foremost, there's still an awful lot of distressed mall loans sitting in special servicing that are pending a resolution. And there's also a shadow population of malls that were either modified with extensions or granted short-term relief, during the depths of COVID. So as these loans in special wind their way through the foreclosure process and ultimately end up as REO and are sold, there's likely to be some additional downward pressure on values, and it's going to take some time to sort out kind of that additional bifurcation of mall resolutions. On the performing mall side, I think other than your upper echelon malls, malls that are maturing in say the next 18 months to 2 years may encounter some problems refinancing. To date, we've generally seen servicers agree to extensions on performing loans. But if past downturns are any indication, kicking the can down the road usually only delays the inevitable. Now, I think in this downturn, with a bit of a quicker recovery than we've seen in the past, perhaps more of these properties, particularly those with some deep-pocketed, committed sponsors, may benefit from additional time to increase cash flow and allow the lending markets to settle a bit. But near-term maturities are going to need to be scrutinized, I think, in the next year or so beyond the typical cash flow, occupancy, debt yield, LTV metrics, in light of what's going on in the lending markets. On the hospitality side of things, by and large, hospitality loans have generally weathered the storm fairly well. We've even seen loans that have been delinquent for the vast majority of 2020 and 2021 that are now being brought current with some very minor forbearances put in place. I think the rate of hotel loans being cured over the last few months has spiked pretty dramatically. And hopefully, this current Omicron variant ends up being a minor blip in the hotel recovery. But we do have some concerns about the wherewithal of hotel borrowers who have had to come out of pocket for the better part of 2 years now to fund debt service and operating expenses. As we reach this 2-year anniversary of the onset of the pandemic, we do sense that some of those borrowers are not going to have the wherewithal to continue funding shortfalls. And then there's always the one-off loan in a deal that can add additional negative stress. And right now we have obviously some concern with office as back to work sorts itself out. We're not seeing the sector-wide stress on that yet, but there are going to be one-off properties that we need to take a look at with whether it's lease roll or increasing already increasing vacancy that are going to again deserve some extra scrutiny. So overall, as I look back at what we did in 2021 and what we're looking at for 2022, I think we've accounted for a good deal of stress in our rated book, either through the downgrades or by assigning negative trends. But there's still some lingering weakness in retail and hospitality that needs to work its way through the portfolio. And as I mentioned there at the end, we need to see what the ultimate impact is on the office sector, which I think it's going to take some time to manifest itself across the sector. But we will certainly have one-off properties in the meantime that need our attention. So lots to do on the surveillance side. And Gwen, I'll hand it back over to you.
Thanks, Dave. Yeah, so great overview there. Obviously, a lot of moving parts, but I think where we stand today, one of the most tangible examples of how these things can play out and impact our forecast for loss, have been these defaulted loans where we have maybe issues prior to the pandemic, sponsors, operators making decisions about what the loans they want to remain committed to, the assets they want to retain in their portfolio. And to that note, our stronger operators, Simon and Brookfield, who acquired the GGP portfolio, those loans have not been immune to the impacts that we've seen. Obviously they had some assets in their portfolio that were underperforming prior to the pandemic, and then amid COVID-19 have both of those operators have had a good chunk of loans transferred to special servicing, and some have even been situations where those operators have said we're walking away and they've handed keys. We have a resolution for one of those operators that we'll talk about later in the presentation. And so I think one of the things that we talked about a lot prior to the pandemic was because obviously we were seeing these trends, but one of the things that you could get comfortable with and expect to provide some cushion versus what happened in CMBS 1.0 is we did have a more conservative approach in general for underwriting these loans that were contributed to 2.0 transactions. So you generally had low LTVs, higher DSCR. So we've got a loan that we're going to talk about right in this presentation that we're obviously very concerned about and is contributing to negative trends. It's covering it 3 times, and you have those challenges on how to deal with those. And I think the term I used earlier, tangible. We've seen when these loans have defaulted and they go 60 days delinquent and the special servicers are obtaining new appraisals, that the trends that we're seeing have been pretty alarming. The value declines have been very sharp, and it really erodes the benefits that we have in some of those structural things that we were kind of leaning on prior to the pandemic. So on that note, I want to turn it over to Joe Shmigelsky, who's going to walk us through some trends and observations on the mall valuation front.
Hi, good morning. I'm Joe Shmigelsky, Assistant Vice President of DBRS Morningstar. Today I'll be discussing the research our analytical team conducted, which focused on the appraisal reports for distressed regional mall properties issued in CMBS 2.0 transactions. Our team extracted data from appraisal reports from when the loans were originated and all other updated appraisals during the respective loan terms. In this first slide, it shows the actual liquidation and realized losses of 4 DBRS Morningstar rated regional malls since March 2020, the onset of the pandemic. Here we can see the loss severities, both in actual losses and percentage of each loan, ranging from 25% to 70% loss severity, with an average of 52%. One loan not shown on this slide is the Simon-owned Montgomery Mall, which liquidated in November 2021 and was reflected in the December remittance report. That pari passu loan resulted in a $47.4 million total loss with a 47% loss severity. The largest loss by percentage was McKinley Mall in Buffalo, New York at 70%, while the largest by loan volume was Burnsville Center at $45 million loss. The loan sizes for these malls represented a large concentration of conduit transactions, and losses greatly impacted rated bonds, leading to several downgrades, as Gwen and Dave had mentioned. And this next slide shows the appraised value declines, leading to increased LTVs for these 4 DBRS Morningstar rated loans that were liquidated during the pandemic. Most of these loans transferred to the special servicer prior to the pandemic. As you can see, the value by per square foot sharply declined for these loans before the onset of the pandemic. For example, Ridgemar Mall's value declined 87% since issuance, while Burnsville Center's value declined 83%. Values declined even further during the pandemic in cases when the malls were reappraised again prior to liquidation. In this next slide, it represents 5 DBRS Morningstar rated specialty service loans, not yet liquidated, with more than one appraisal since transferring to the special servicer. We can see sharp declines for 4 malls, which are Westfield Palm Desert Mall, Woodbridge Center, Newgate Mall, and Indiana Mall, while observing a modest decline for Visalia Mall. Indiana Mall originally had an appraisal pre-COVID that already showed a 70% value decline prior to the pandemic. 4 loans were reappraised in Q3 and Q4 of 2020 with an average value decline of 70% from appraised values at issuance. Of the 4 loans, 2 were reappraised for slightly greater amounts in 2021, while the other 2 were reappraised for considerably lower. DBRS Morningstar believes that appraisers may have slightly overestimated COVID's impact on some malls, but underestimated the impact on others. In this next slide, it shows the primary reasons for appraised value declines since issuance, which were increases in cap rates and NOI declines. There are 24 DBRS Morningstar rated specialty service loans that have received updated appraisals since issuance. Most loans in special servicing that were reappraised were issued in 2011, 2012, and 2014 vintage deals, which was well before online retail really accelerated. A majority of loans transferred to the special servicer during the pandemic, and cap rates in updated appraisals were nearly twice as high as they were at origination. The median cap rates for 15 appraisal reports in 2020 was at 14%. An additional 13 appraisal reports conducted in 2021 reported a median average of 15%. Queen Cow Manu Center was an exception with a cap rate of 6% in 2020. However, that mall's NOI was 63% below its NOI at origination. The highest cap rate was at 22% in 2021, which was Oxford Valley Mall in Middletown Township, Pennsylvania. As mentioned, the appraiser stabilized NOI significantly declined compared to origination. The median average appraiser NOI decline was 29% lower than it was at origination, primarily driven by increased vacancy and lower base rental income.
Thanks, Joe. Sorry, I was muted. Committed the ultimate party foul amid COVID-19. So just real quick, I wanted to jump in because obviously, you're showing some pretty eye-popping values there for cap rates, and I want to, I guess, make it clear that obviously you're speaking to loans that have had new appraisals come in, distressed assets. So we're not generally seeing these trends, at least to this extreme, for new loans being contributed to CMBS. I know we're going to talk about that later, but I wanted to get your thoughts on that while we're on this topic.
That's correct, Gwen. I pulled some cap rates from recently securitized loans during the pandemic and found much lower cap rates ranging from 4.1% to 7.5%. These loans were typically Class A malls with very strong sponsors such as Simon and Brookfield, and were located in DBRS market ranks of 5 or greater. So these are very desirable assets.
Great. Yeah, 22.5. That's something, Joe.
Well, finally, I'd like to show the 5 DBRS Morningstar rated loans with the largest value declines since issuance that remain in special servicing. These loans are now considerably over-leveraged, and significant principal losses are expected. Value declines range from 75% to 91%, which is comparable with recently liquidated loans. Of the 24 specially serviced loans with updated appraisals, only 3 loans had LTVs of less than 100%. Losses are projected for nearly all of the specially serviced loans. Properties with the largest value declines typically lost at least one anchor tenant during the loan term and are located in secondary and tertiary markets. Bankruptcy filings from Sears, JCPenney, and Bon-Ton over the past 5 years stressed several of these Class B and Class C malls, as these anchors were primary traffic generators at the malls at issuance. All major sponsors had properties that transferred to the special servicer during the pandemic that later appraised for below their respective values at origination, including Simon and Brookfield. So no sponsor was completely immune from having a distressed mall within its portfolio.
Thank you, Joe. So we've heard about the valuation trends, and some of the malls that Joe highlighted in his section contributed to rating action drivers. So to give some examples on that front, I want to turn it over to Sgorlon, who's going to walk us through some of the transactions and rating actions in the last year.
Yeah, thanks, Gwen. So for the next part of this webinar, I'll be highlighting a few examples where we encountered mall loans in our surveillance reviews. And we'll also explain how we got comfortable with our analysis approach and the rating actions that followed. In most cases, these malls have been significantly affected by the pandemic and have either been monitored on the servicer's watch list or have transferred to special servicing. So there's a few general questions that we hope to answer with these loan discussions. Firstly, how do we incorporate the possibility of value declines into our analysis for both specially serviced and watchlisted loans in absence of updated appraisals? We've seen from Joe's data that there's been several appraisals completed in the last year that show haircuts from their issuance values in the 60 to 70% range. So how do we use this information to look at various loans, regardless of if we believe a liquidation is imminent or not? And second, for loans where we believe liquidation is forthcoming and there's been an updated appraisal, what's been our analysis approach for these loans and what types of rating actions have we been taking? I wanted to start off by talking about the Morgan Stanley 2011 C3 deal, since the deal is now over 90% backed by 2 regional malls, both of which are specially serviced. However, neither mall has been reappraised since issuance. The larger of the 2 malls in the deal is the Westfield Belden Village. It had been previously owned by Westfield, but was sold to Starwood as part of a larger portfolio in 2013, and the loan transferred to special servicing in May 2020 due to monetary default as a result of the pandemic. As part of the purchase, Starwood refinanced the portfolio with Israeli bonds, and in 2020, they defaulted on these bonds, which then triggered a clause that allowed the bondholders to seize control of the assets. And this portfolio was eventually auctioned off in 2020, and the winners were the California-based Pacific Retail Capital Partners and the New York-based Golden East Investors. The loan itself had not previously been a poor performer in the years leading up to the pandemic, but it had been reporting declining cash flows since 2013. And we'd also been monitoring it after its non-collateral Sears vacated in 2018. Now that space has since been redeveloped and it has been backfilled by Dave & Buster's, Dick's, and Golf Galaxy. Another important thing to note about this loan is the recent modification that was agreed on to bring the loan current. The mod entails a 5-year maturity extension to July 2026 and also includes a period of interest-only payments from July 2021 through December 2022. And then from January 2023 onwards, P&I payments will resume. So overall, not the worst story we've seen. There's a few positives, mainly the quick redevelopment and releasing of the Sears space, and the loan modification is certainly encouraging as well. Nevertheless, the loan had been delinquent since May 2020, and although an updated appraisal has not been provided, it is likely that there has been some sort of value decline from issuance levels. Given the deal's concentration in only 2 loans, we felt that running a model would not be the best way to analyze the deal, so we considered various liquidation scenarios for the 2 largest loans to get a sense on how the capital stack would shake out. And this is not to say that we think a liquidation is imminent, but it did give us comfort in our rating upgrades for the top 2 classes and the negative trends on the bottom classes that could potentially be susceptible to losses in the future. In absence of a recent appraisal, however, the main question becomes, at what value do we feel comfortable assigning to this mall should a liquidation occur? And as we saw with the data Joe presented, recent appraisals have frequently come through at haircuts ranging anywhere from 50 to 70% in comparison to the issuance values. So for this review, we looked at liquidation scenarios with haircuts of 50, 60, and 70%, which represent values per square foot of $114 to $189, and then observe what the capital stack would look like should any of these scenarios occur. We took a similar approach for the Oxmoor Center loan in this deal. Just a bit of background before I move into the analysis approach. This is a Brookfield-operated mall in Louisville that transferred to special in July 2021 for maturity default. And although performance has dipped after the collateral Sears vacated in 2018, Brookfield has given no indication that they're giving up on this mall, and they too have agreed to a loan modification that includes a maturity extension to 2023, and among other items, a principal paydown of $4 million. Notably, Brookfield has signed Topgolf to take over the redeveloped Sears space at a significantly higher rental rate than Sears had been paying. So the mall appears to be heading in the right direction despite the low cash flow in the last 2 years. As mentioned, we took a similar approach with this loan and looked at scenarios where an adverse value decline could occur, and then took stock of the ensuing capital stack after these hypothetical liquidations. And ultimately, we decided to upgrade classes C and D to AAA, as we observed that even in an adverse liquidation scenario, these bonds would still successfully be repaid. On the other hand, for classes E, F, and G, we observed that should an adverse liquidation scenario materialize in line with other specialty service mall loans, there is the potential for losses to these classes and at the very least significant credit erosion. And although we do not consider this an imminent possibility, we felt that the negative trends on those classes were appropriate to signal the possibility of downgrades in the future. Keeping on the theme of Brookfield malls, they also own the Mall St. Matthews, which is also located in Louisville, and it's only 1 mile away from the Oxmoor Center that I just discussed. This loan makes up 4% of the 2013 GCJ14 deal and a larger portion of the GC13 deal, which is not rated by DBRS Morningstar. We've noted in the past that the 2 malls had complementary tenancy and that the proximity and shared ownership were not previously viewed as significant concerns. However, as the landscape for regional malls has changed significantly in the last year, there is a possibility that operators may be less inclined to own multiple properties within close proximity, especially in secondary markets. Like the Oxmoor Center, Mall St. Matthews transferred to special due to maturity default after it was unable to secure financing for its June 2020 maturity date, and the current workout strategy is likely a loan mod. In the years leading up to the pandemic, the mall reported consistent occupancy and cash flow levels that were in line with issuance expectations. And while cash flow did fall in 2020, the loan still reported a healthy 1.69 times DSCR last year. Despite this, an updated appraisal as of August 2021 reports a value of $83 million, which represents a 70% decline from the issuance value of $280 million. and is also well below the current whole loan of $164 million. And given the overlap in the Louisville market and the loan's delinquency in 2021, we opted to analyze this loan with a liquidation scenario when we last looked at this deal in March of last year. And our approach at the time was to take a 50% haircut to its issuance value and liquidate the loan, and this resulted in implied losses of $7.7 million, which is a loss severity of 22%. Next slide, please. Looking at the deal as a whole, there are other problem loans outside of Mall St. Matthews, including a couple of hotel loans and another smaller regional mall loan in the Indiana Mall. I won't get into specifics on this one as it was a pre-pandemic transfer, but it is noteworthy that it's located in another tertiary market and notably had struggled with vacant anchor spaces for many years. And ultimately, a new appraisal as of November 2020 valued the property at only $5.3 million, which is an 80% decline from its issuance value. And we analyzed this one as well with a liquidation scenario with a loss severity approaching 100%. And because of these two liquidation scenarios, there is serious credit erosion, especially at the bottom of the capital stack. And that was the main driver for our downgrades on classes F and G. Although the updated appraisal for Mall St. Matthews came in lower than we were expecting, we opted to mitigate this possibility and account for any additional negative developments by extending the negative trends further up the stack to class D. Moving on to the 2014 Lc16 deal, we reviewed this one in March 2021 when we downgraded 5 classes, 2 of which were investment grade, and assigned negative trends to 1 class, with the majority of downgrades to CCC and single C ratings. The rating downgrades and negative trend were primarily driven by the loss projections for the liquidated loans, specifically the 3 largest specialty service regional malls, which at the time represented 24% of the pool. And in total, there was approximately 31% of the pool in special servicing at that time. Of the 3 loans that I'll focus on today, all of them reported significant value declines as of the most recent appraisal, 1 or more vacant anchor spaces, and also declining performance going into the COVID-19 pandemic. Also wanted to point out that at the time of review, interest shortfalls were reaching all the way to the Class C certificate, which was downgraded to a CCC in the March 2021 rating action. Shortfalls continued to accumulate and got as high as the Class B certificate before being repaid as of the December 2021 remittance, where they now reach Class D. So the first loan that I wanted to highlight in this deal, the Woodbridge Center, it's secured by a 1.1 million square foot portion of a 1.7 million square foot super regional mall in Woodbridge, New Jersey, 30 miles southwest of New York City. The mall is owned and operated by Brookfield and transferred to the special servicer in May 2020. The mall is anchored by Boscov's, Dick's Sporting Goods, and a non-collateral Macy's and JCPenney. And the mall also has vacant anchors in Lord & Taylor, which vacated in January 2020, and also Sears, which vacated shortly thereafter in April 2020. Going into the pandemic, the subject's revenue was steadily declining from $40 million at issuance to $34 million as of year-end 2019, before bottoming out at $30 million in 2020. At issuance, the subject was valued at $366 million, declined significantly to $104 million in December 2020, and then most recently declined once again to $90 million in September 2021. In our analysis for this loan, we ran a liquidation scenario based off the $104 million valuation, which projected a loss severity in excess of 70%, and this was a significant contributor to the overall rating actions. In terms of updates since then, in addition to the new $90 million appraisal from September, a receiver was appointed in late October 2021 with foreclosure as the determined workout strategy for this loan. The next loan is Montgomery Mall. It's secured by a portion of a regional mall in North Wales, Pennsylvania, 22 miles north of downtown Philadelphia. The collateral is owned and operated by Simon, and at the time of review, it was noted by the servicer that the sponsor would not be injecting any more capital into the asset, although loan modification discussions were still ongoing at that point. This mall is anchored by JCPenney, Dick's, and a non-collateral Macy's and Wegmans, and the subject did have a Sears, which vacated in February 2020. Similarly to Woodbridge Center, at issuance revenue was $22.3 million, declined to $18 million in 2018, and then to $16.8 million in 2019. At issuance, the subject was valued at $195 million, which then declined to $61 million as of August 2020. And in our analysis, we liquidated this loan based on that $61 million valuation and concluded to a loss severity in excess of 50% during our review. In terms of updates since the transaction's review, we did receive an updated appraisal dated April 2021, valuing the subject at $57.5 million, representing a minor decline from the previous August 2020 value. Following our review in March, a receiver was appointed and the asset was marketed for sale. And Cohen Retail Investment Group out of Great Neck, New York, purchased the mall out of the foreclosure sale for only $55 million, which was roughly in line with our projections from our March 2021 review. And as of the December 2021 remittance, the loan has been liquidated from the pool with a loss split across the two transactions it was securitized in. And lastly, Oakcourt Mall, although it is a smaller loan than the previous two, it also followed a similar trajectory and approach in our last review for this transaction. It's secured by a portion of a 700,000 square foot regional mall in Memphis, and it also includes a 126,000 office building. The loan is sponsored by WPG and is classified as a Tier 2 asset in its financials and transferred to special servicing in May 2020. The subject has a similar tenant makeup in Macy's and Dillard's Women. Dillard's Men was also a tenant at the subject and received a short-term lease extension, which expired in January 2021, and that space remains vacant to date. As of January 2021, the special servicer and borrower had agreed to a preliminary loan modification that would include the extension of the loan term beyond its original April 2021 maturity date, and it would also include the deferment of debt service payments and also the implementation of hard cash management. At issuance, the collateral was valued at $61 million, declined significantly to $15 million in 2020. And we used the $50 million valuation in our liquidation approach and projected a loss severity in excess of 70% as part of this deal review. Since the March 2021 review, its appraised value increased slightly to $15.5 million, and forbearance talks stalled, and the borrower has indicated that they wish to convey the title to the trust with a receiver appointed in May 2021 with a current strategy to foreclose and stabilize the asset for sale. Pivoting away from delinquent malls for a moment, I want to talk about another 2013 vintage deal, more specifically about a loan being monitored on the servicer's watch list. We last looked at the COM 2013 CCRE 6 deal in March of last year, and our analysis was centered mainly around the Avenues Mall loan, which makes up over 12% of the pool. And this is a Simon-operated mall in Jacksonville, and while it's remained current throughout the pandemic, there are a few things that give us cause for concern. First, the mall has experienced a significant drop in occupancy, primarily due to its collateral Sears vacating at the end of 2019. Occupancy fell to 58%, and as of the March 2021 reporting, there's been no leasing activity to speak of. Another observation that we made was that Simon has actually recategorized this mall within its portfolio, excluding it from what it deems to be its core assets. And in terms of cash flow, it's trended lower nearly every year since issuance. And as of year-end 2020, it was 25% below the issuer's underwritten levels. Despite the occupancy and cash flow declines, the loan is still covering at a comfortable 2.95 times. But as we saw with Mall St. Matthews, a healthy SCR doesn't necessarily mean there has not been a value decline. Next slide, please. So we wanted to quantify the potential for a value decline and the elevated refinance risk into our model run for this loan. And we ultimately decided to take a 60% haircut to the property's issuance value and then adjusted the loan's LTV in the model based on the new implied value. And by doing this, along with a probability of default adjustment, the result is a higher expected loss for this loan in the model, and that was the main reason for the negative trends on classes E and F. And with that, I'll pass it back to Gwen.
Thanks, Alex. Yeah, so you mentioned, at the end there in the discussion about the avenues, which, just quickly would mention, as part of some other malls that I went and saw in Alabama, Georgia, and Florida towards the end of the year last year, I visited this property and felt we were completely justified in the actions that we took. And, it's the dark Sears is there. I think there's another dark Anchor, and this mall is huge. And it's obviously it's not the good mall in the area. There's another mall in Jacksonville that we have in another rated deal that's the attractive asset there. I went to that mall as well. It was very busy. This one was not busy. The interior corridor was pretty depressing, to be honest. So, and we've been trying to do that as we can, see some of these malls and, do an updated tour, kind of get a feel for the tenant mix that's there, what kind of shopper traffic, where it's located, so that we can, better inform ourselves when we're making these types of decisions. And as you mentioned, in the case of that loan, it's not in default. It's current. As far as we know, Simon hasn't given any indication otherwise to the servicer, but obviously we have concerns and we think it's an issue. So we treated that loan not with a liquidation scenario, but with a stress scenario that increased the expected loss at the pool level. What, I guess, did you want to expand a little bit, Alex, on, where we as analysts might make the decision to either liquidate the loan, take the losses of the bond stack and address it that way versus leaving it in the pool with a stressed probability of default?
Yeah, it's a great question, and it's something that we're constantly thinking about when we do these deal reviews. There's not one main factor that determines whether we choose to liquidate a loan or not, but rather a combination of a few different things. Things like occupancy, cash flow, what market they're in, who the sponsor is. All of these are different factors that we'll look at when deciding on how to treat a loan. Take, for example, the Montgomery Mall, or another loan that I hadn't talked about in Oxford Valley Mall. Both of these were specially serviced. They had vacant anchor spaces, not located in the strongest markets. And although DSCR wasn't terrible, cash flow has trended lower in recent years. And then you tack on updated appraisals showing value below the current loan amounts. And in Montgomery Mall's case, a sponsor that explicitly stated that they're no longer going to be investing any additional capital into the mall. And it slowly became clear that liquidation was the way to go for these two. On the other hand, something like the Avenues, where occupancy and cash flow declines were concerning, but the sponsor has continued to keep the loan current. Yes, we do think there's increased risk, but given that the loan hasn't fallen delinquent yet, we felt that making a POD adjustment would be the more appropriate treatment.
Yeah, and I mentioned I saw the Avenues. You mentioned Montgomery Mall. Dave, you visited that property. I know that's within the Philly area, and you have some observations about that one and maybe Oxford Valley.
Yeah, sure. So yeah, Montgomery Mall, it's the one that's closest to our office in suburban Philadelphia. And full disclosure, I'd go there as a kid for school shoes, so my working knowledge of that mall goes back to unfortunately goes back to the late '70s at this point. And I've pretty much hated it since the late '70s because it is the mall that I would go to for shoes and not for toys. So perhaps there's some bias in my views on that asset, um, but interestingly enough, as I pivoted, to analyzing as a piece of real estate as opposed to the mall I went to as a kid, I realized how little the interior of that mall had changed in the 35 years since then. And for me, the biggest change over time there was that they put a Wegmans, which is an upper scale grocery chain on the East Coast, in one of the anchor spaces, but it had no flow through to the inline space. So, I think ultimately it kept occupancy up and it kept the parking lot full, but it did very little to increase the foot traffic for the traditional retail space in the interior. And that really played out. I was there several times, before and after the transfer to special, and walking the interior of that mall it was clear that it was on a swift and precipitous decline. And without going through, it looked like a typical dying mall on the inside. But the last time I was there, Alex mentioned that it kind of lingered in special servicing for a while with kind of some talk of a modification or a foreclosure. And I was there while it was lingering in special servicing, and I noticed that every reference to Simon anywhere in the mall had been hastily painted over. And by hastily painted over, it looked like somebody walked the mall with a tray of paint and a roller, and just did a white line over every reference to Simon on any materials. The frontage of stores, the coming soons, was all whited out. And not going to claim to be Sherlock Holmes, but this led me to deduce that this loan was going to be REO pretty soon, which turned out to be true. And as Alex mentioned, it ultimately liquidated from the trust, or from the two trusts, I guess. Interestingly enough, just as an aside, the Wegmans there is now being marketed for sale by that new owner. And it may be something to keep an eye on as a trend going forward for malls that have a grocery component. There's another mall that's in close proximity to my home office here, which isn't a CMBS property. It's a a REIT-owned regional mall that's kind of teetered along, but they're marketing the connected Whole Foods for sale, while maintaining the rest of the mall. So something that's popped up over the last couple of weeks that's interesting to look at. But I think the pictures of there's pictures through our viewpoint site of the interior of Montgomery Mall, and it was pretty desolate. And a brief note on Oxford Valley, again, a suburban Philadelphia mall. I visited this one a couple of times as well during the pandemic. This is not one that I grew up hating because I had to buy shoes there, but nonetheless, again, the inside was fairly typical of what you'd expect from a distressed mall. A lot of local tenancy. The food court, there's not a whole lot of sit-down options there, but the food court itself was kind of bereft of any national chains. But what was outside the mall was more noteworthy to me. A pretty big section of the parking lot of that mall had been converted into tractor trailer parking, complete with new lining on the in the parking lot to account for the bigger vehicle sizes, and porta potties. And doing a bit of research, I found a site online that's marketing the spaces for rent. So clearly, no expectation that shoppers are going to use that section of the parking lot anymore. It's been, at least temporarily converted into some sort of tractor trailer, overnight parking uh, area. So, I think, given what Gwen mentioned on the property she saw and what I saw, it's not possible for us to see every distressed property in our book, but I think it's worthwhile to point out that, taking a walk through some of these properties gives us a bit more perspective, in an attempt to highlight what's going on at these malls and what we can glean from the IRP reporting. I think the numbers tell part of the story, but walking a property and seeing what's actually going on, even seeing open stores that have the gates down, because there's not, and this is even before the current, the current spike in cases, seeing, what appear to be functioning stores with the gates down saying we'll be back in 2 hours. That's certainly not something that happened normally. And contrasting that to King of Prussia, which is obviously a different class of mall to begin with, but having been through there within the last month, you would have no idea there was any kind of stress in the retail environment at all going on. So just some firsthand visuals of what we've seen at some of these properties.
Yeah, that's a good point, Dave. We've definitely gotten some good ground level intel. I know the mall in Cumberland, Georgia, you rushed right down there to those apparel stores that I sent you photos of to refresh your wardrobe with the latest styles. So
I meant to wear that for today, but I forgot.
Darn it. Yeah, so I guess I want to circle back to Joe really quickly, because one of the things that you note looking at the deals and the loans that Alex highlighted, you have a lot of Brookfield and Simon sponsorship. And I think that might run a little counterintuitive to what we might expect, where, obviously those stronger operators, the deeper pockets, the better relationships with retailers that want to be in their core assets, maybe deals they can make for the non-core assets or the non-core locations. I think those have buoyed performance for those loans, so it's a little bit of a surprise. I think the concentration that we've seen for those larger operators, but again, they're savvy operators. They're taking a look at their portfolios and they're deciding what makes sense on a go forward perspective, especially with the compounding effects of the pandemic mixed in. So we do continue to monitor, and I know Joe, you've been monitoring closely the developments with those weaker sponsors, two of which CBL and WPG that filed bankruptcy amid the pandemic. So, any update on those that you'd like to mention?
Yeah, thank you, Gwen. So sponsor strength is a key component when analyzing these malls. And we have been concerned about the financial wherewithal for both CBL and Washington Prime Group prior to the pandemic. So it was no surprise both of these companies filed for bankruptcy during an economic downfall. We gathered some updates for both of the companies. So CBL voluntarily filed for Chapter 11 bankruptcy in November 2020 at the height of the pandemic, citing cash flow concerns. Most of that was caused by several of their own tenants filing for their respective bankruptcies and have since reemerged. So the company CBL has emerged themselves from bankruptcy in November 2021, and as part of the reorganization, the REIT has reduced its debt by 1.7 billion and will carry more than 1.4 billion on its post-bankruptcy balance sheet. And then following some bond redemption and bankruptcy related costs, CBL will have approximately $260 million in cash or other liquid assets on its balance sheet. We did find an updated or a recent Jefferies analysis report dated October 2021 that showed retail rents have been growing across the country and most strongly in the Sun Belt area. All of CBL's Tier 1 properties, which are categorized as malls with tenant sales greater than $375 a square foot, are located in southern states. So at least their portfolio is located in a more favorable economic location. As for Washington Prime Group, the company filed for bankruptcy just this past June. At the time of the company filing bankruptcy, it listed $4 billion in assets and $3.5 billion in debt. The company emerged from bankruptcy recently in October 2021, and as part of its reorganization, the REIT reduced its debt by $1 billion. In exchange, the REIT's largest creditor, SVP Global, swapped its debt holdings for ownership shares. Washington Prime Group will now operate as a privately holding company with the majority owned by SVP Global. As for its portfolio, its core properties reported an average occupancy rate of 92% as of June 2021, flat from 12 months prior. Meanwhile, inline store sales within the Tier 1 properties increased 2.1% to $433 a square foot for the 12-month trailing period ended June 2021. That actually compares favorably to $424 a square foot for the same period in 2019. This indicates that its Tier 1 properties have recovered and are performing above pre-pandemic levels. A few points that DBRS Morningstar will be watching for in terms of sponsors. The sponsors have realized somewhat of a K-shaped recovery. However, there appears to be more mall losers than winners. More properties within sponsor portfolios have nearly recovered to pre-pandemic levels if they haven't already. It will be even more difficult to monitor, though, the sponsor strength now that more sponsors are privatizing and are not posting quarterly statements. DBRS Morningstar does anticipate Simon and Brookfield to remain strong in the medium and near term, but the remaining sponsors will have to remain competitive attracting retailers, especially given their limited financial resources.
Thanks, Joe. All great points. And, to be clear, we obviously have, a fair number of malls. Alex did mention the Oak Court Mall, a WPG mall, that we have loss forecasts that are driving rating actions, and we have others as well. I think that, those are generally smaller loans than some of the Brookfield and Simon loans. So the impact to the overall bond structure is lessened as a result, but, certainly have issues with those sponsors. And as Joe mentioned, continuing to monitor. So with that, I want to turn it over to Hatim to maybe end this on a bright note. I think, obviously, I consider myself the typical suburban shopper. I spent a lot of time in brick and mortar retail, shopping for the holidays, making use of some of the new ways to shop, buy online and pick up in store and curbside pickup, things like that. So I think, we are seeing an evolution of things. And I think there are some bright spots, obviously some positive developments. So I want to turn it over to Hatim to walk us through some of the trends and things that we've observed.
Thanks so much, Gwen. So I'll be going over key themes and shifts in retailer and landlord strategies, and specifically how these are impacting tenant rosters. So what I'll try to do is, for the first part, I'll focus on retailer strategies, and then I'll move on to some of the things that landlords have done in response to sort of the evolving retail landscape today. So, to begin, I think it's important to note that retailers have, especially in the last 18 to 20 months, come to the realization that a large physical footprint doesn't necessarily translate into greater sales volume, and that hasn't been more true, than in today's evolving retail landscape. And while we're seeing most retailers maintaining a physical footprint, there is a renewed importance of leveraging their brick and mortar locations, with really strong digital strategies and innovative tools and solutions for consumers. So there's been a lot of debate surrounding the future of retail, and I think one thing that sort of seems to be the common consensus is that the retail experience is changing. It is being revolutionized. Arguably, the COVID-19 pandemic has catalyzed trends that were already underway, and it's forced many retailers and landlords to innovate, push up their business plans, and expedite their strategies as well. So in specific, I just wanted to highlight sort of 3 points. We're seeing, to begin with, we're seeing a renewed focus on technology and digital tools to maximize productivity, efficiency, and convenience for consumers. And retailers today are using tech to streamline consumers' visits to the physical store, while also allowing them to have a more immersive experience from the comfort of their home. So we're seeing expanded online presence, expanded capabilities to create more interactive in-store experiences. And then we're seeing things like the rollout of appointment booking platforms, concierge services, smarter and more dynamic loyalty programs, and the use of virtual reality and artificial intelligence for product testing and simulation. And these are just a few examples of tech-focused strategies. We're also seeing increased investment in digital infrastructure and logistics to shore up same-day delivery services and the endless aisle distribution strategies that a lot of brick and mortar stores are implementing. Along with that, we're seeing an uptick in social media investment and obviously digital marketing campaigns to target the new era of shoppers. Secondly, the pandemic has put safety and convenience back into the spotlight. So, what we're noticing is that today's modern day shopper doesn't want to wait in long lines or go through multiple layers of interaction during the visit to a mall. But at the same time, they are looking for convenient and personalized experiences. And in response to this, we're seeing retailers investing in their BOPIS capabilities, which is buy online, pick up in store, something that Gwen had mentioned, as well as their curbside pickup and one-day shipping options, which are today's modern day consumers finding more and more important. We're also seeing a renewed focus on, like I mentioned above, the endless aisle distribution strategy that can deliver goods to a store or a consumer within 24 hours or less. And that's become pivotal for many retailers looking to marry both their retail and physical, their physical and digital footprint. We're also seeing the introduction of ancillary benefits. So things like a consumer backdrop, lounge areas, private appointment rooms, they're becoming increasingly popular at malls and sort of something that consumers are now becoming used to. Retailers are focusing more on product placement as well to facilitate faster and more streamlined trips for consumers. So you'll notice they have grab and go areas in one section of the store, and then they'll have browsing in the other section to allow consumers to sort of come in and create a nice clean flow for them. The challenge for retailers today is really how to keep dwell times up while keeping foot traffic consistent and maintaining a safe, clean, and efficient environment for consumers. And just my last point here is we're seeing sort of the repurposing and leveraging of existing physical footprints while rethinking the traditional role of the store. So, what exactly does this mean? It sort of means innovative store formats and retail partnerships are on the rise. For example, we're seeing retailers partnering with popular ice cream brands and cafes. You'll notice that they have little setups or stalls in a lot of retail spaces, and that's an attempt to drive foot traffic through the door. And this is all part of a larger effort to keep, to create multi-purpose experiential environments that keep consumers around in the store for longer. Sort of a couple of examples that were noteworthy. More and more Canada Goose locations, for example, have what they call winter rooms that has fake snow. It mimics sub-zero temperatures where you can go inside and try their jackets on. We're seeing sporting goods stores that have turfed areas where you can try golf clubs and running shoes. And these are experiences that you won't be able to participate in online. So retailers are beginning to offer, not only experiential environments, but also an increasing diversity of product lines. Typically, research has shown that retailers that offer a higher diversity of products fare better during downturns as opposed to those that offer singular product lines. And sort of just lastly on this point, we're sort of seeing retailers are keen to incorporate products that capture the casualization of lifestyle and the work from home revolution. So, for example, athletic leisure clothing, homeware, furniture, electronics, they've all performed pretty well during the downturn, or the most recent downturn, I should add. So, retailers are looking to add sort of an increasing diversity to their product line to drive foot traffic through the door. And then they're also using the retail footprints as a hub to not only offer sales, but to offer convenient services to consumers as well. So it seems like an integrated omni-channel platform and innovative consumer solutions are going to be key to the overall brand experience moving forward. And as consumers demand convenience, safety, and personalization, we'll begin to see a shift in how retailers respond and how they combine their power of their physical, digital, and virtual strategies to create a unique brand experience, whether a consumer is at home or in the store. Can you just get the next slide, please, Gwen? So
I was too fast, Hatim. I'd already forwarded it. So sorry. We're on here now.
I noticed that by the time I looked up, it was already done. So my apologies. So for sort of the second part here, I'll just sort of end off my section with sort of how mall landlords are responding. And one of the key themes we're seeing is a greater desire on landlords' parts to invest and work together with retailers while also taking on more risk and entertaining new and novel strategies that they may have not thought about 2.5 years ago. Some of the most adaptive landlords have realized that the traditional shopping mall of the 1950s no longer meets the needs of today's modern 21st century consumer. And as such, we're seeing a lot of dynamic landlords adapt to change by thinking outside the box and creating environments where people can not only shop, but where they can eat, play, and work as well. So I spoke in the earlier slide about retailers focus on curating multi-purpose experiential environments, and similarly, landlords are doing the same by using common areas in malls to provide immersive and exciting spaces for consumers who flow through. So a couple of examples are, the incorporation of mixed-use spaces that cater to leisure activities, the introduction of office space and residential space in mall premises, and as well as adding flex space that can be used for events, roadshows, and community needs. And some of these things are proving to be great for traffic drivers. We're also seeing landlords incorporate more showroom-style spaces, pop-up locations, and increasing floor space allocation for food and beverage. Something interesting and noteworthy was in the 1990s, about 5% of GFA was typically reserved for eateries and food service. That's a jump to 15 to 20% today on average, and then there's talk about that going up to about 50% in the future. So having a significant portion of GFA sort of reserved for non-retail uses. Secondly, I just wanted to touch on landlords attracting more diverse tenants and consumers through curating a careful range of retailers from both a pricing perspective, so value, mid-range, and high-end, and embracing novel concepts like autonomous stores and increase in self-checkout stations, for example. And we're seeing landlords shift to a green, environmentally friendly, and sustainable model as well. So outfitting their buildings to attract eco-conscious tenants, while at the same time, we're seeing a lot of capital being spent on improvements in filtration, HVAC systems, for example, as well. Landlords are also pushing to increase the amount of outdoor space where consumers can flow between interior and exterior. It's been sort of shown that the more outdoor space consumers have to flow in and out of, sometimes the longer they'll stick around. So that sort of increases dwell times for landlords. And I'll just finish off lastly with the point of social media, which is sort of important today. A lot of malls are deploying coordinated public relations campaigns to rebuild the outdated image associated with traditional malls. So, there's a push to rebrand the malls of the late 1900s. And according to recent surveys, during the renovation process, 1 in 5 malls are removing the word mall from their name, and they're sort of trending towards terms such as shops, villages, galleria, or town center, and these are words that typically denote community, intimacy, and luxury, and sort of shifts away from the traditional image that people have of malls, and that's sort of really the key themes of how landlords are responding, and sort of I'll end with that, and I'll maybe Gwen, I'll pass it back to you at this point.
Thank you, Hatim. Yeah, all very interesting. We're seeing these things play out. And I think in the interest of time, we're going to go through some of the retailers and landlords that we're seeing employing these strategies. But I think what's an important thing that I want to make sure we have time for, and I'll turn it over to Wasiq for this, but, we are seeing, new mall deals getting done in CMBS. They've been all SASB transactions and as Joe mentioned earlier, core assets. So I'll turn it over to you, Wasiq, if you want to walk us through, what we saw in the last couple of years in terms of new origination.
Sure. Thank you, Gwen. Yeah, we're running up on time, as you mentioned, so I'll make this very quick. So just briefly looking at the regional mall leverage metrics. So how did that compare, at the onset of the pandemic, compared to 12, 18 months. And basically, what did those metrics look like in 2020 and 2021? So looking at a few examples, for example, Mills at Jersey Gardens, Oak Brook, Mall in Columbia, and Westchester. Those metrics in 2020 were generally very, very strong, with lower LTV percentages from 26 to 49%, more double-digit debt yields between 10 and 18%, and DSCR ratios of 2.7 to 7.5. So kind of fast forward to a year into the pandemic, those metrics softened up a bit, but still overall very strong in 2021. So kind of looking at those 6 examples noted, the LTV percentages came up a little bit from 38 all the way to 65%. You have more single-digit debt yields between 8.5 to 14%, and then DSCR ratios between 2.16 to 4 times. But just showing, in order to kind of originate those regional mall transactions in 2020, those metrics had to be very strong. And in general, I think that trend holds true as well, especially for regional malls with highly desirable core assets. I think we'll continue to see very strong loan metrics that are desired to get these deals done, especially carried through to 2022 as well. So back over to you, Gwen.
Thanks so much, Wasiq. Yeah, some interesting stories there. I think Willowbrook Mall stands out. That's the Houston Willowbrook Mall. That was in a conduit transaction and repaid, and that $300 million issuance value, I think it was valued at $305 million in 2011. So, we're within shouting distance. That's kind of was kind of a surprise, I guess, from my standpoint, that it ended up in a SASB, especially when you look at it in comparison to some of these other very core, very strong performers. Willowbrook's more of a middler, I would say. But the location is strong. Looking at the occupancy and the cash flow trends, they've been stable. So there is still space for those malls, and I think we'll continue to see those kinds of deals get done. You have a strong operator in place there as well. So definitely continuing to monitor those. And I think, as Dave mentioned earlier, we have some upcoming maturities. So it'd be interesting to see those performing assets that are in, CMBS 2.0, the 2012, 2013 vintages, how those play out in the next couple of years. If we see those popping back up in conduit deals, how those get taken out, because, we talked a lot about the underperforming assets in the sector, but there continue to be performers. There continue to be a need for this property type, and as Hatim was mentioning, it's taking some creative efforts on the part of retailers and landlords alike to make sure we're making the best use of those properties. But I think it's not all doom and gloom, and I'm glad we ended on this note with these very strong properties and seeing how some of that has played out from an issuance standpoint. So. We are at the end of the time for our scheduled remarks. We don't, I think we have a question. Let me see. Yeah, we have a request for a copy of the presentation, and yes, we can certainly share that with you guys. Any questions that pop up after, feel free to reach out to any of us. We'll be happy to answer. Again, this is a topic that's very front of mind for us, and there's always something new happening. So happy to discuss and interested to hear outside perspectives as well. So thanks everyone so much for your attendance. Thank you so much to our presenters, and Happy New Year, everybody. Thank you.